What's up, YouTube? It's Chaim Victor Schramm here, back with another video, and today I'm here to tell you to look at this photograph. And now that I've used that meme up, that makes this the most important video I'll ever make. And thankfully, it's a pretty important topic because today we're talking about the fact that the stocks have never been this high. Look, stocks are at record highs, and that doesn't make them the most expensive that they've ever been in isolation. But here's the thing, they are the most expensive that they've ever been in valuation, even more expensive as of last week than the dot-com bubble itself, the previous all-time high. We thought we would never get more expensive than. And most of you are millennials, and you may not even remember the dot-com bubble. And you may not remember things like pets.com, other than it being a funny commercial and a mascot. But it was a funny thing to do with your money to buy pets.com stock back in the previous all-time bubble before meme stocks were ever a thing. And today, we're back in that zone again. Here's the graph again. It's a creepy graph. It's the reason that this video even exists. The S&P 500 is trading at 3.23 times sales. That's a record. Investors are paying over $3 for every dollar of revenue that companies actually even bring in the door. And historically, that's pricey. Part of the chart is actually cyclically adjusted price earnings ratio. That means it's adjusted for inflation even. And now the non-inflation adjusted price to earnings ratio isn't quite at dot-com levels, thankfully. We're at about 22.5 times projected earnings versus 20-year running average 16.8. Still high, not crazy. What's keeping it up are big profits and big profit margins, more importantly, especially at the big tech companies. That would be the NVIDIAs, the Microsofts, the Apples. There, we're really talking about the thing that's giving us a glimmer of hope. And for people who were looking for a glimmer of hope, profits are the thing. Companies actually are earning more money, and that means we could get even higher all-time highs, even on the cyclically adjusted chart, perhaps even this year. And speaking of big tech, that's where things get interesting because the top 10 companies, they make up more than 40% of the entire index value. That's NVIDIA, Apple, Microsoft, Tesla, a couple others. They are combined more than 40% of the S&P 500's entire weight. And what that means for you as an investor in 2025 is we've historically called the S&P 500 index of stocks the market. Is it a market, or is it really 10 really big companies and 490 smaller companies that the rest of us don't care as much about? We saw the risk of this in April. They showed up concentration risk. It's called a risk for a reason. When tariffs got announced, those giant tech stocks tanked, and they tanked more than everything else. And in fact, they dragged down the entire index that, frankly, wasn't all reacting that strongly at the same time. When these 10 stocks now fall, the whole market falls. And to move from memes to classic cliches, that's too many eggs in one basket. A little more nuance for those of you who are trying to stay hopeful. Like we said, if you strip out the mega tech stocks and give every S&P 500 index company, the whole other 490 stocks, an equal weight, valuations are not crazy. There you have a 1.76 times sales ratio. The average, like we said, it's about 1.4 over very long time periods. The whole index, it's way more than twice. Here, we're not that much higher than the long running average and not particularly unreasonable, not what we would call bubble territory. So you got 10 stocks in a bubble and 490 stocks in not a bubble. But what that means on the other side of the coin is, yeah, we don't have to really be too worried about those 490 stocks valuations. We don't have a ton of money to lose per se, but it also means the market is not that excited about the large majority of our stocks. And some of them, you can't really blame them. You got the T-Mobiles, you got a couple others, Altria, Citigroup, those are sitting at the bottom of the S&P 500 by weight. Nobody's really excited about these companies in 2025, and that's how we arrive at that kind of valuation mismatch. We're really excited about the prospects of just a handful of stocks and pretty bored about everything else. They're cheap. Maybe they should be. The bigger question for folks like me is sustainability of this whole thing. At some point, valuations matter. $9 trillion stocks, nine stocks that have $1 trillion. These stocks can't keep growing if they don't keep making money, frankly. They got to keep doing it. How far can they take that? We don't really know. But we do know that they have a pretty high bar to reach just to break even in terms of valuation terms. You have a lot of stocks that have a lot of room to beat expectations and be exciting. But like we said, those are low weight in the index. They don't make as much a difference to the whole market's returns if they all have killer years. And that's important to name. And in terms of investment strategy, that tells you a lot about what might be good in 2025 to do with your money. Listen, if you've been thinking this whole time, is this late stage capitalism? You're right. It's definitely late stage capitalism. And frankly, we use the phrase late term because it's not a quantity. It has never been this late, but it could get potentially quite later. And what does that mean? The chart that we've just been looking at and all the things that I just said, they're not actually what we call timing tools in their own right. You can't run out and say, hi, I'm just said to sell the stock market short because it's coming down. It's actually not true. I wouldn't say that it's not the takeaway. The takeaway is inflow of dollars in your portfolio, especially if you're adding new money to portfolios. You should probably be looking outside the US. You've probably heard that from me like at least 3 times this year. It's still true. It's more true. It's going to keep being true for probably years on end. So if you still haven't got around to tackling that in your portfolio, this is your thing to do. Call your financial planner, your portfolio manager, whatever it is, and say, let's get a little bit more diversified. Because frankly, we are in uncharted territory. We don't actually know what's going to happen. So stay tuned. Bye.